Welcome to this bite-sized video that gives a basic introduction into OAK. The OAK tool is an OECD BEPS compliance from an IP management perspective readiness assessment tool. In order to fully understand and truly appreciate OAK, one must first understand OECD BEPS. The Organisation for Economic Cooperation and Development, OECD, is at the forefront of efforts to improve international tax cooperation between governments to counter international tax avoidance and evasion. The OECD G20 Base Erosion and Profit Shifting BEPS package of measures has been agreed upon with over 100 countries and jurisdictions, confirming their commitment to consistently implement this comprehensive package. The package provides 15 actions ranging from new minimum standards to revisions of existing standards, common approaches which will facilitate the convergence of national practices and guidance drawing on best practices. Described by the OECD as the most significant rewrite of international tax rules in a century, the BEPS package provides countries with the powerful tools to standardize compliance requirements and force firms to be transparent about where they generate income. Simply put, more and more tax authorities now view OECD BEPS as their Bible when it comes to intergroup licenses and transfer pricing of intangibles between group members. Although I use the term OECD BEPS compliance throughout this short video, please be aware that others may use alternative terms, such as transfer pricing compliance or double taxation risks. To better understand OECD BEPS, it is worthwhile noting that the chief goal of OECD BEPS is to stop tax avoidance by M&Es, and in particular tax avoidance using intangible assets like IP. M&Es were using a variety of different approaches to do tax avoidance. The IP value approach. This approach leverages intergroup licenses and transfer pricing. The IP risk approach. One may think of this approach as being like the IP insurance model, namely you pay someone else to take the IP risk, except here it is about self or captive IP insurance. The IP financing approach. This basically involves the use of financial loans between group members. And the lowballing R&D approach. This approach tends to be used by M&Es with R&D activities located in high-tax jurisdictions. The company deliberately compensates the R&D unit on a cost-plus basis rather than compensating the R&D unit based on the true value of their output. OECD BEPS consists of 15 actions developed to address tax avoidance. However, looking at these 15 actions, it is clear that the OECD BEPS guidelines are not just about tax. They can be seen as an IP management handbook, dictating how companies should behave when managing their intangible assets. I suggest that OECD BEPS actions 4, 8, 9, 10, and 13 are especially relevant from an IP management perspective. An essential feature of the new regulations is an emphasis on intangible assets. It is increasingly recognized that intangible assets create a substantial part of the business value. However, until now, there has been no single definition of intangible assets in use by tax authorities or the OECD, and no proper guidance on how such assets should be reported. The accurate and complete identification, taxation, and valuation of intellectual property and other intangible assets is now recognized as one of the most important areas of the international tax reform and transfer pricing legislation. Compliance means conforming to a rule, and the OECD guidelines clearly define new rules as far as M&E's IP management is concerned. Assessing compliance is an activity to determine, directly or indirectly, that a process meets relevant standards and fulfills relevant requirements. I suggest that such a conformity assessment may be broken down into at least 9 parts: qualification, definition of intangible assets, IP data management, maturity of the M&E's IP processes and systems, transfer pricing, IP risks, the financing of IP activities, reporting, and exceptions. In the OECD guidelines, it defines intangible assets as including the following categories: patents, know-how and trade secrets, trademarks, trade names and brands, rights under contracts and government licenses, licenses and goodwill. It is worthwhile noting the OECD BEPS defines intangible assets in broad terms and does not limit it to registered forms of intellectual property like patents and trademarks. OAK is not a tax tool, but rather an IP management tool. The purpose of OAK is to help the in-house IP manager better prepare for the new tax environment when it comes to intangibles and intergroup licenses and transfer pricing. I suggest that it is much better to sanity check if your company is OECD BEPS ready from an IP management perspective when times are calm and relaxed as opposed to when times are crazy and turbulent. An example of a crazy or turbulent time would be when your company is in the middle of a tax audit by the tax authorities. One tax expert described OAK as like a bridge across the interface between the IP and tax functions within a company. Another described it like a translation of OECD BEPS from a tax document into an IP management handbook. In essence, OAK has codified this IP management handbook in the form of an assessment tool. OAK runs on a secure online GDPR compliant platform. It comprises of a detailed structured questionnaire together with various guidance notes. The output of any OAK assessment would be a report, which I believe should feed into a meeting between the in-house IP manager, the in-house tax director, and the company's tax advisory firm to determine what steps to take to address any issues or concerns. The OAK tool is an OECD BEPS compliance from an IP management perspective readiness assessment tool. It is an IP management tool and not a tax tool, but very much sits on the interface between the IP world and the tax world. Thank you for your attention.